As a reformed investment banker, my interest in gold started in 2008, and I hear a lot of talk about scarcity of money. I'm not sure that's absolutely correct. I think we are in a liquidity and cash glut globally. The key question we have to ask is, why is that money not coming into mining assets, and specifically mining assets in Africa? I'm going to do something, I hope, a little bit different. It's going to be part economics lecture. That's my banking background. It's going to be a part contract sale of an opportunity in South Africa. And then it's very definitely going to be a part request for cash. We're building a mid-tier listed South African gold producer. We're targeting 200,000 ounce per annum gold production over the next decade from a pipeline of well-known high-quality shallow gold deposits in the Wits. So there hasn't been a new junior producer listed in South Africa for a long, long time. The challenges are incredibly well known, so we're not naive to those facts, but hopefully I'm going to put forward a thesis today that will change that. Firstly, the part economics lecture, why now? Globally, debts have been increasing faster than revenue. The debt load globally has become completely unsustainable. We used to talk about trillion-dollar deficits on an annual basis. Anyone who's watching the United States, they ran an $836 billion deficit in June alone. So the rate of debt increases is increasing exponentially. 2008, when I was the managing director of Macquarie Bank South Africa, was a critical decision point. Governments fundamentally had three choices in front of them. They could follow a program of fiscal and monetary consolidation, raise taxes, cutting spending. That tends to get you unelected very, very quickly, and hence an unpalatable decision for politicians. They could have defaulted on their debt obligations. Again, governments are addicted to debt. It's what fuels the machine, and we're seeing those challenges now coming home to roost in South Africa. Or they could attempt to inflate away the debt burden. They could print money. I was managing director of Macquarie Bank Europe at Ben Bernanke's speech at Jackson Hole in September 2009. He announced quantitative easing on the Friday. I resigned on the Monday to go and buy a gold mine. And I'll talk to you about why today. So since 2008, we've seen global central bank balance sheets increase from just over $3 trillion to close on $22 trillion as of July this year. That's a sevenfold increase, and that is literally money printed out of fresh air, and we're seeing an over 17% compound annual change in the money supply. I want to quote one of the most famous Austrian economists, Ludwig von Mises, and I'm not the portent of doom and gloom, quite the opposite. I think it's an opportunity. But he said there is no means of avoiding the final collapse of a boom brought about credit expansion. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. And what is that catastrophe? That catastrophe is a devaluation of the currency, and it's happened many, many times before. The COVID crisis has shown us that we have chosen not to abandon the expansion of credit, quite the opposite. And the result of that, so when I started in 2008, the gold price was just on 200,000 Rand a kilo, and for any gold bulls in the room, we've seen a nearly 500% return, compounding at close on 14% per annum. And that is being very definitely reflected in the gold prices of South African gold producers, specifically through 2019 and 2020. To use a trite, and Peter Major will know this, trite investment banking phrase, the trend is your friend, we fully anticipate that we're going to see a continued acceleration in the gold price, both in US dollars and in emerging market currencies. In South Africa in particular, our rapidly deteriorating fiscal position, in our opinion, is likely to accelerate the trend with sustained pressure on the rand. So we're seeing an incredibly strong emerging bull market in precious metals. Bernard, I hope I have your support for that. And we are seeing huge pressure on the rand. Both of these are incredibly bullish. And this is not purely a South African-based trend. This is happening across the continent. All emerging markets are struggling with currency pressures right now. So what is the opportunity? Opportunity is real assets are likely to materially outperform over the medium to long term. Real assets are tangible things. It's ARC Minerals, it's the new projects up in Zambia, Botswana, it's platinum companies. It's anything that is not denominated in its fundamental form in fiat currency. In our opinion, this represents a huge opportunity for South Africa, potentially the largest economic windfall of our lifetimes for mining companies. We missed the 2008 commodity boom, largely due to the political environment. In our opinion, we cannot miss it again. We're going back into another boom market, particularly for precious metals, but again, for all real assets. And as a commodity-rich economy, as a commodity-rich continent with significant need for economic growth, this is a windfall that we cannot afford to miss. In South Africa, we've got some of the best underground mining people in the world. South Africa is a mining country. We have a huge endowment of mineral resources, global ranking, #1 resources for chrome, gold, manganese, PGMs, #2, fluorspar, titanium, vanadium, vermiculite, zirconium. We're one of the 15 countries in the world that holds 85% of the world's hydrocarbon assets. We've got massive mines, plants, power, transport, related infrastructure. This economy was built on mining. What's the critical third leg? And that's the one that has been coming up consistently in these endowers, is capital. And I've personally spent a huge amount of time outside of the country trying to raise capital. It's not easy, but we believe the winds are shifting, and the winds are shifting simply by virtue of economics. The risk-reward equation is moving in South Africa and Africa's favor, in our opinion, and again, we're starting to see that in the share price performance of our listed miners. Going to gold now, we need a new strategy for tackling the Wits. We have to view the Wits through a different lens. In South Africa, if you find a 1 million ounce gold deposit, 4 gram a ton in situ, it's considered uneconomic. It's a tadpole. If you find a 5 million ounce gold deposit in South Africa with 4 gram a ton, it's considered uneconomic. In the rest of the world, if you find the same deposit, you've got a listed mining company. We know why. A lot of it is regulatory, a lot of it is the environment, a lot of it is the narrative, but geology and economics going to change. South African gold mining is developed down 2 paths, what we see in the industry today. We see ultra deep level mining, places like Imponeng, South Deep and others, technological marvels, profitable at these gold price levels, but with massive sunk capital behind them, and hence absolutely committed to their strategy, and it's the right strategy for those mining companies. The marginal capital deployment to continue those mines to extend their lives makes sense. In the second route, we've seen Mine Waste Solutions and DRD Gold both doing unbelievably well, is the retreatment of dumps. But there is an enormous chunk of ground in between those two. And that's a vast overlooked set of shallow virgin gold deposits. I've heard lots of people talking about exploration at the Indaba. In South Africa, we don't need a lot of exploration. It's one of the things that fascinates me is a lot of these deposits are known, well known, drilled, explored, have shafts in them. So we continue to look for new deposits, and we're overlooking the ones that we have already. And for me, that's the bigger opportunity. These deposits are incredibly well understood geologically and metallurgically. They're extensively drilled and modeled. And another huge advantage we have in South African gold is that they're in proximity to significant underutilized existing infrastructure. There is pretty much dormant plant and tailings deposition fully licensed sitting all across the Witwatersrand Gold Basin. It's available for tolling, it's available for purchase, and that goes a huge way to lowering your capital costs, compared to having to go into a place like Zambia or Botswana or others where you need to build roads, you need to build power. All of that is available. So what is the Shallow Reefs Gold story? This is our company. Is to acquire and develop the target portfolio of 1 million ounce plus mineable gold deposits. We want to operate above 1,200 meters below surface. We're looking purely at virgin ore bodies. We're not interested in remnant or pillar mining. We're looking at deposits of greater than 4 gram a ton run of mine. At today's money, that's 4,000 Rand a ton revenue. When you put all of your losses in place, even if you assume the same operating costs that we're running at the much deeper level mines, those are incredibly profitable assets to run. Access via trackless decline infrastructure where possible. Something that's been overlooked, very successfully deployed by Neil Froneman at Modi East. Our target asset portfolio, we're in the process of acquiring and engaging, so I've kept the projects private. We're looking at 5 deposits. Right now, we have a portfolio of others, all above 1,200 meters. We're looking at just over 21 million ounce gold resource at 4.7 gram a ton. Most of that is NI 43-101 or SAMREC compliant. and one of the assets has a nearly 2 million ounce proven probable reserve at 4.3 gram a ton.